focuses on a particular point in time, so a balance sheet is on a certain date, and then an income statement that's based on not a certain date, but between 2 dates. So an income statement shows the flow within a company over a period of time and shows the changes effectively in the balance sheet accounts. And we'll look at how all of these are linked together, the balance sheet and then the income statement. So balance sheet showing a particular point in time. And in a balance sheet, if you have a traditional one where you have on your left side your assets, on your right side liabilities, with Starbucks, we had everything listed in a column. But in a traditional one, the assets generally are on the left side, liabilities are on the right side, along with owner's equity or shareholders' equity. So the left side of the assets, these are the resources of the firm, what the firm uses to generate sales, to become profitable. And these are the ways that the firm finances the acquisition of those resources. They can either get their assets by borrowing money or issuing liabilities, or they can raise money by issuing shares and having equity. Generally, some of both. Questions about that? And so the accounting equation, and this is something we're going to go back to again and again this week, is just that your assets must equal your liabilities and owner's equity. So anything that you have as a productive asset has to be financed either by liabilities or owner's equity. So the accounting is a balance. So assets are economic resources of the company, and they'll be used to generate cash flows, produce revenues, possibly prevent future cash outflows. So examples of assets are things like cash, inventories, equipment, or the normal things, but they can be any of a number of other types of assets. It can be things like accounts receivable. So just money that your customers owe you, that's an asset. Something where you are owed money. So we'll look at that later. And then liabilities are just the obligations of the business to outsiders. So either to debt holders or to creditors or to anyone else who's providing capital who's not a shareholder. And then owner's equity is, yes. So it could be an asset that saves you money. So it would be like something that makes your business more efficient and so prevents you from spending money. So something that you invest in to improve the efficiency. So let's say you have a plant and you want to... So it could be many things. So it could be something like you make an investment in plant and equipment to make your business more efficient, to reduce costs and outflows. So it could be something like that. It could be something like, it could be fixed assets, but it could also be something like prepaid insurance. So you buy insurance, and the insurance is there so that if you have a loss, you don't have a cash outflow. So you have an asset that's kind of protecting you. That's a more direct example. Okay, so generally liabilities can be bank debt, notes payable. Other liabilities can be like we had accounts receivable where we're lending money to our customers. A liability would be accounts payable where our suppliers have provided us with credit. Yes. Yeah. Right, so that would be prepaid insurance, because usually you pay the policy at the beginning of the period and you have the insurance. So, and we'll talk about that. It starts off as an asset, and then if you use the insurance over the period, then you recognize the expense. So you reduce that asset to nothing. If nothing, and even if something happens, then that's a separate payment. But the protection itself is something that you start off with a full year's protection, and then each period you reduce that because you've used it up. Then, after 3 months, you only have 9 months left of insurance, so you reduce that prepaid insurance by 25%. We'll go through a lot of examples of this. Do you have another question? Well, it's an asset only because it can protect you against losses, and as it disappears or not become an asset, then you have to take that money that you were calling it as an asset and move that into an expense, and then the asset will disappear by the end of the year. We'll go through some examples. Other questions? Accounts payable. We're talking about insurance still. So if you buy the insurance on credit, then you would have an accounts payable, or you haven't actually paid for the insurance yet, but you have an asset, and you have a liability accounts payable that offsets the asset. If you actually buy the insurance and pay up front, then you have an asset, insurance or prepaid insurance, and then you expense it over the life of that insurance policy. During each period. So we'll do an example. Good. We've got 5 days, so we'll have plenty of time to really explore this, maybe much more than you're interested in, but we'll see. So, okay. All right. Open account is just another way of saying on credit. And so in a business, most of the goods that you sell customers, most of the goods that you get from your suppliers will be based on credit. That's the normal, not always. Some businesses operate on a cash basis. Some operate on a partial cash, partial credit basis. It really depends on your relationship with the supplier or with the customer. And sometimes if you have concerns about a customer's credit worthiness, you might put them on a cash basis rather than extending them credit. So that happens also. You see a lot of firms that are in financial distress, their suppliers start saying, all right, we're only going to deliver goods to you if you pay cash, which puts them further into financial distress because now they have to come up with all this cash that they were previously just getting by credit. Okay, and so the two things you get from open accounts are accounts payable and accounts receivable. Questions about that? All right, so every transaction of a company affects the balance sheet equation. So no matter what the transaction is, or it will have some impact on assets or liabilities or owner's equity. And you can almost say that that's almost the definition of a real financial transaction or accounting transaction, is that it has to be able to affect one of these balance sheet equation categories. Okay. And a company is, by definition, something that stands apart. So when you look at a company, you have to be able to say, this is the company and this is everything outside of it. And so accounting is that process of accounting for what's going on in the company and the transactions that go from inside to outside the company and so on. And so the accounting is on a separate economic unit. So you need to have something that can be designated as separate so you can have a proper accounting. And a transaction is something that affects the financial position of that separate economic unit that can be reliably reported. Reliably reported means that you can value something, you can measure cash flow, something can be put down that you have confidence in as a fair representation of that transaction. Now, the account summary is a record of changes in asset liabilities and owner's equity items. And so all accounting systems have a double entry system. So each transaction must affect at least two accounts. They may be both assets, both liabilities, both owner's equity, or they may be an asset and a liability or some combination. But it has to affect two. So whenever we report a transaction, we're going to say this is the effect on one account, this is the offsetting effect on another account. And that's what keeps the accounting equation in balance. A compound entry would affect more than two balance sheet accounts. So the minimum is two, but you can have entries that can affect three balance sheet accounts, possibly more. So here's an example of a very simple transaction. We have a company that we're calling Upstart, and they have just started their business. And so what they've done is they have a founder, and as is common with smaller businesses, the founder puts up the capital. So Smith has put up $400,000 of capital, and so in order to account for that first funding of the business, the first thing the business does, we have to show we now have $400,000 in cash in our business, and we got it from Smith. So Smith owns the business, and he is entitled to this $400,000 in cash. So just that. So this is called paid-in capital. Paid-in capital is the amount of money that is paid in when a share is first issued. There are a few little distinctions. There's paid-in capital, and there's also par value and some other things we'll talk about later. But in this case, we're just going to say this is the capital that he put in, or Smith put in, and that's their investment. And so the balance sheet equation is 400,000 equals 400,000. Questions about that? Yeah. Right. So if instead Smith, instead of buying shares or taking shares in his own company, that he lent the money to the company, and it would be a liability. Yeah. Now, like most business owners, they want to get some outside capital also. And so since Smith has put $400,000 in there, it would be relatively easy to go to a bank and say, oh, I want to borrow another $100,000. So I have $400,000 of equity capital and $100,000 of debt capital in the form of a note payable from a bank, or in this case, from a private funder. So this would be a private placement. Anyone know what a private placement is? So, that's where instead of borrowing money from the public or from a bank, you borrow it from the institution. So you're not issuing a bond, you're just going to a lender or an institution and doing a private placement. Okay. And so now that the Upstart has borrowed $100,000, now the assets are $500,000, all in cash. It has a liability of $100,000 on that note to the private placement, and there's still the same $400,000 of original capital. Next, you have money, but you don't really have a business until you have some productive assets, unless you're in business investments. And so now Upstart has acquired equipment for $15,000 in cash. And so that $15,000 has to be taken out of cash, and a new asset is created, which is called equipment. And so that's worth $15,000. So you bought an asset, you created an asset. Excuse me, you used an asset to create another asset, your equipment. No effect on the right-hand side of the balance sheet. So what would be another way, if this was not equipment, this was spending money for some sort of service or something that was going to be used immediately. So we wouldn't create an asset. So here we're capitalizing that equipment. So instead of saying the equipment that we bought is an expense, we're saying it is now an asset that we capitalize. So we're not going to make any change over here in owner's equity. We haven't incurred an expense. Yep. Yes, it does. It reduces cash, but basically you're converting one asset cash into another asset equipment. And so this side balances out and stays the same. It's just you have less cash and you have a new asset. You know what? Yeah, yeah. This is the balance. So yeah, all right. 15,000 is used for. Okay. Okay. Well, then instead of having it in equipment, you have it in inventory. Yeah. So which is another asset account. So depending on what you're you know, using in your business, and eventually we will buy inventory. We're going to use this example and expand on it and buy inventory and do lots of other things. So eventually this will grow into a pretty big set of transactions. This is the first one. So we finished up by talking about buying an asset for the business, exchanging one asset for the other, cash for this equipment. The equipment will be brought as an asset, but it's not an expense, it's an acquisition. So the balance sheet for Upstart at the beginning of January would be cash, 485, equipment 15, total assets 500, and then on the liabilities and owner's equity side, liability of 100 to the private placement, paid in capital by Smith, 400,000, total 500. So we have everything in balance there.